With the Tesla stocks reaching new heights, the company's now got the potential to be worth $40 trillion. Hello everyone, and welcome back to Everything Tesla Stock. What are these opportunities that could make this happen though? The bullish prediction originates from Morgan Stanley's MOACC. 5 thoughts on the mother of all Capex cycles research report. What a reputable company like Morgan Stanley had to say is unexpected. And in this video, we're going to reveal why this $40 trillion opportunity will make Tesla reach new heights. Stick around until the end to find out. Before we start though, if you like this type of content, hit the like button, subscribe, and turn on notifications to keep up to date on everything going on with Tesla. Morgan Stanley is a multinational financial services company that specializes in investment banking, securities, wealth management, and investment management. The firm's personnel serve clients from all over the world, including corporations, governments, organizations, and individuals, through offices in more than 41 countries. As of March 31st, 2022, Morgan Stanley Investment Management and its investment advisory affiliates had over 1,200 investment professionals around the world and $1.4 trillion in assets under management or supervision. Morgan Stanley Investment Management is to provide a varied customer base, including governments, institutions, organizations, and people with excellent long-term investment performance. Tesla Inc. remains the unrivaled leader in the electric vehicle race. According to a Morgan Stanley analysis, the business will likely lead the auto industry in shifting away from the fossil fuel economy. The Tesla is rated overweight by Adam Jonas, with a $1,300 price target. Tesla is a paradox for investors, since it's both expensive and cheap at the same time, according to Jonas in a note. If the company is regarded as a pure automobile company and the valuation is based solely on the number of units sold multiplied by the average selling price of cars, the analysis believed that it might be overvalued. If the broader auto industry does transition to EVs, which is a big if, then they might play a major part in re-architecting the renewable energy and transportation economies. Morgan Stanley believes that $20 to $40 trillion in aggregate Capex and R&D must be spent over the next 20 years to transition away from fossil fuels. But this is where it's going to get interesting for Tesla. This is a substantial sum of money, and our main concern with traditional automakers is that they have a sizable industry centered on the ICE, internal combustion engine vehicle. Legacy automakers are attempting to serve two masters with this massive commitment, ICE and EV, and they can only serve one, and if it isn't EV, then they're going to go bankrupt. Morgan Stanley believes Tesla may be greatly undervalued when it's seen as a renewable energy onshore infrastructure company. They regard Tesla as the ultimate battery capital expenditure play, with a $1 trillion market cap in their grasp. According to Morgan Stanley, energy innovation will be renewed as a result of 2 key events: war and inflation. They anticipate developments over the next 6 months that will fundamentally alter the narrative surrounding what Tesla does, the markets it serves, its growth profile, and the global strategic ramifications of the ecosystem on which it sits. Morgan Stanley believes that investors are beginning to recognize Tesla's benefits in going straight to customers, whereas incumbent automakers are banned from doing so by strong state dealer franchise regulations. This is something else that we agree with. Tesla may sell automobiles whenever they want. Legacy automakers utilize outmoded dealerships with questionable sales practices, as well as additional partnerships and red tape. Morgan Stanley believes that larger forces are driving the new multi-decade trillion-dollar battery Capex cycle. As globalization transitions into a new phase marked by increased worries about national security, investors must consider new energy supplies and supporting infrastructure. Battery storage will be crucial in the future, and Tesla is prepared to lead. Tesla will be able to produce more batteries than anyone else, according to Musk, who has claimed that Tesla will actually start their own mining operations, either by purchasing mining firms or by establishing their own mining operations from inside. It's reassuring that Morgan Stanley is considering Tesla's prospects outside of the automobile industry. However, their price goals and earnings per share predictions are perplexing and well below where we see them going in the coming years. Tesla fans are well known for their high valuations. Ron Barron, a well-known Tesla bull, believes the firm will achieve a 3 to 5 times return in 10 years. Cathie Wood's 5-year projection is $3,000, implying a market cap of $3 trillion. Tesla generated decent sales for the quarter, with significant year-on-year growth over preceding sales. Tesla built 305,000 vehicles and delivered 310,000 vehicles, for an annual manufacturing pace of nearly 1.2 million automobiles. Models S and X production and deliveries have nearly ceased, with 17% of new vehicles subject to lease accounting. The high-end proportion of the company is mostly dormant until a new model is produced. Tesla's new Roadster could actually help to resuscitate this area of the business, but it didn't, and there's no indication of that happening anytime soon. The firm made a big fuss about the forthcoming Roadster, and the deadline has been repeatedly pushed back, with the current estimate sitting at 2023. It remains to be seen whether it's going to materialize next year, but Tesla has a history of missing deadlines. However, the business is irrelevant to Tesla unless anything happens. Following that are the Model S and X. These models are, in our opinion, what shaped Tesla into the corporation it is today. However, the company hasn't seen good performance in a long time, and sales are only a small percentage of the business at this point. They amount to only a few $1 billion every year for the corporation. Over the next year, investors will gain a greater understanding of how Tesla and other manufacturers are critical to the transition away from fossil fuels and towards renewable energy, according to Jonas. According to the researcher, nearly $20 trillion to $40 trillion in accumulated capital expenditure and R&D will be spent towards this goal over the next 20 years. According to him, only 3% of this has been allocated and 1% spent thus far. Although Tesla recently redesigned the models, volume sales remain modest. We don't anticipate this position improving materially, especially with the increased top-of-the-line competition in the EV industry from companies like Lucid, Rivian, BMW, and others. Then there's self-driving. Like the Roadster, we believe the opportunity here is essentially vapor. Meta's metaverse business is the most similar. Could the market one day be enormous? Sure, but until then, we don't really know if and when it's going to exist, or if it's even going to have a reasonable market share. Tesla has repeatedly pushed back its full self-driving timetable, infuriating customers who expected it sooner after purchasing pricey packages. Fundamental design mistakes in the company's strategy, like the lack of LiDAR or consumer testing, have not only cost the company money, but may also result in it never edging out its competition. Lastly, we arrive at the Model 3 and why. These low-cost versions are currently the foundation of Tesla's operations. They account for a vast majority of production growth, with a volume of more than 1 million vehicles per year. These companies are massive in their own right, and EV rivalry is heating up. But so far, the competition has come from the major brands. The business expects to end 2022 with a run rate manufacturing of more than 2 million vehicles per year, mostly from these vehicles. With growing competition, we envision Tesla transitioning to a mass-market manufacturer. Toyota, the industry leader in reliable low-cost vehicles, is a viable indicator here, with 40 million yearly vehicle sales and a $280 billion market cap. Tesla's other operations include energy storage and residential solar. Residential solar has suffered in particular, with only a few percent market share. With a 2% market share, the company's just not kept up with the total solar sector. Roof Solar appears to be a small but growing company. The company is seeking to boost profitability here, but with 345 MW of residential solar in 2022 and deployment costs of 2 to 3 million per MW, we have an intensely competitive sector with no useful market position and $1 billion in low margin income. The company's energy storage division clearly has greater promise. The company has experienced much more constant growth, and it's reached approximately 4 MWh installed. In a world where battery demand is continuously increasing, its Megapack solution is pretty unique. Tesla charges around $300 per kilowatt hour in the most recent pricing announcements, estimating a revenue of around $1 billion here too. So we can see Tesla is doing well in this business, and in the long run too. However, we do not believe it is a $1 trillion company maker. In this industry, margins are low and intellectual property protection is lacking. By 2030, demand is predicted to approach 1 terawatt hour. If Tesla achieves a 100% market share, it will generate $300 billion in revenue. But what are your Tesla predictions? Let us know down below. Thanks for watching, and while you're still here, go ahead and click on one of these 2 videos on your screen. See you there.